Hola mi gente and welcome back to the channel. My name is Sean and this is We Are Investing, a channel that's dedicated in investing and personal finance. On today's video, I'm going to show you how to trade options on Webull. Webull currently updated their system and now there is a new way to purchase options. I'm going to show you how to do it. Now before we get started, if you sign up with Webull and you deposit $100, this channel will be rewarded if you use the link down below. I highly appreciate it. And if you do that, you will also get free stocks valued up to $12,600. But with that being said, let's get started. Once you find yourself on the Webull application, the first thing you're going to want to do is you're going to want to look for a stock. In our case, we're going to use Twitter for the example. So we'll click on Twitter, or we will type in the ticker symbol, and then we're going to see this screen with the chart. The next thing you need to do is you need to click on the options tab, which is right next to the chart tab. So we click on that, and this is what's going to show up. Now the traditional way to buy options are through this options chain. That will allow you to buy all kinds of options trading strategies. If you click down below where it says vertical, it might say single for you. Here are all of the strategies that you can purchase through the options chain. I have videos going into this, but that's not the purpose of this video. If we go back to the options page, you can see that there's an option discover, and this is a new function. That's what we're going to be talking about today. So let's click on it. Now this is the next screen you're going to see. Now trading options through this feature is very similar to trading options on Robinhood. It's simplified, it's geared towards beginners. Now with that being said, you don't have access to all of the options trading strategies with this tab. You can do that on the options chain, but if you're going to buy options through here, you are limited on what you can purchase. Now there are two different categories. You have generate additional income, or you have leverage your market view. The traditional one, or the one most people start with, is leverage. If we click on that, it's going to ask you if you're bullish or bearish on the stock. Bullish just means that you think the stock's going to go up. Bearish just means you think the stock is going to go down. Now, if you're bullish, you can buy a call and you can be long a call option. This is just buying a call option because you think the stock is going to go up. And then if you are bearish and you click on the bearish button and you think the stock's going to go down, you can buy a put option and you can be long a put. The process to buy a call is the same as buying a put. So for this video, we're just going to show you how to proceed by buying a call option. So if you click on a long call, the next screen that's going to pop up is the expiration date. Any date that has W at the end is a weekly option. Not all options or not all stocks offer weekly options. But if a stock offers options, it's definitely going to offer the monthly option. And these are expiration dates that do not have W after them. For example, the next monthly option, which is the third Friday of every single month, is September 16th, 2022. Let's proceed by buying a call option that expires on that date. So you click on that button. The next thing you need to do is you need to select a contract. Your contract will either be in the money or out of the money. In the money are any strike prices that are below the current stock price. The current stock price for Twitter is $41.05. So the $41 call is in the money. It's basically at the money. The $40.50, the $40, anything lower is considered in the money. Out of the money options are strike prices that are above the current price. For instance, the $41.50 strike is out of the money, the 42, the 43, the 44, so on and so forth. There's some other information that's relayed on this screen, such as the bid and the ask. The difference between the bid price and the ask price is the spread. Essentially, the bid price is what buyers want to buy this option for, and the ask price is what sellers want to sell it for. If you can buy an option that's closer to the bid, that's better for you. It's going to be cheaper and it's going to cost you less. Two other things that are here that are very important are your open interest and your volume. When trading options, it's important to find a position that is liquid, meaning it's easy to trade, it's easy to buy, and it's easy to sell. This will increase the chances of you getting a fair price and getting out when you want to. So what you want to see are options that have relatively high volume. Volume corresponds to the amount of contracts that are traded in one given day. Open interest corresponds to the amount of contracts that are currently being held. High open interest and high volume are good for you as a trader. So let's say we're bullish on Twitter and we want to buy a call option and we're going to buy something that's slightly out of the money. Let's say we're going to buy the $43 strike. To proceed, you're going to click on that, buy $43. You're going to unlock your trading, and then this is the screen that's going to pop up. If you scroll down, here's where you're going to enter your limit price, how much you're willing to pay for this contract, and how many contracts you want to purchase. Now, if you click on the limit price, here's going to show you what the bid price was, what the ask price was, and what the mid price is. You want to get this filled closer to the ask, which is $1.19. So we can go at $1.25. This is going to be the difference of buying this contract for $125 versus $142. So it's important to look at the spread and try to get an order filled closer to the ask. The next thing you're going to want to do is you're going to want to pick the amount of contracts you have. Now you got to keep in mind each contract's for 100 shares. So even though this says $1.25, it's going to cost you $125. If I want to buy 5 contracts, it will tell me the debit down below. In this case, it's $625. Webull will also give you a nice profit and loss graph. If you scroll back up to the top and you hit that long call button, here's your graph. It's going to tell you what your break even is. It's the strike price plus how much you're paying. So in this case, $43 plus $1.25 is $44.25. Your max profit for a long call is unlimited, and your max loss is how much you put in. And then if you look at the profit and loss graph, you can see that your max loss occurs at the strike price at $43. You see that because the red portion of the graph flattens out at $43, and it converts to green at your break even, which is $44.25, and it continues up on a slope. That's because your max profit is unlimited. When you're ready to fulfill your order and you're ready to buy this contract, you're just going to hit done, and then the next screen is going to pop up. I'm not going to go into that because I'm not actually going to buy this, and it's after hours right now. So if we go back a couple screens, if you wanted to buy a put option, which is bearish, the process is the same. I'm not going to dive into it. I have many videos regarding Webull. Just check out the playlist. Now, if you want to sell options and you want to create passive income, you can do that here as well. We're going to hit the income tab. And this is a little bit more complex. It's a little bit more complicated, and it's more for advanced traders. We have videos going in detail about cash accrued puts and covered calls, which are the 2 types of options trading strategies available in this tab. We'll dive into them briefly here. To get started, let's take a look at cash accrued puts. So we're going to click on that. Now the process is the same. You're going to pick an expiration date. We're going to pick the same expiration date, the monthly for September. Now cash accrued puts, typically, most of the time, you're going to want to sell a cash accrued put that is out of the money. So for put options, out of the money is actually opposite from call options. You want to sell a put option that is below the current stock price. Stock price $41. And typically I like to sell cash accrued puts that have a delta of 0.2 or an 80% probability of being out of the money, which in our case is the $34 strike. If you take a look at the $34 strike, you can see the probability, OTM, the probability of this being out of the money at 82%. So we're going to click on that. Now here, opposite of buying call options or buying puts, we are a seller, or also known as the writer of this contract. So when buying calls and buying puts, you want to buy something for as cheap as possible. But now we're the seller, so we want to sell this for as much as we can. With that being said, if we hit the limit price, here's our bid and our ask. In this case, we want to be closer to the ask price, which is 64 cents. So we can sell this for 60 cents a contract. Now cash accrued puts are a little bit different, and I'm going to dive into this here as well. The best way to do it is to look at the P&L graph. So here we go. Here's our break even of $33.40. That is the strike price minus how much we got paid, which was 60 cents. The max profit is $60. 60 cents times 100 times the amount of contracts, which in this case was 1. And our max loss is negative 3,340. Let me explain what that actually means. Now, a cash accrued put is a strategy where you sell a put option against a position. But basically, you have cash on the side to be able to buy 100 shares at the strike price, which in our case was $34. Someone would use this strategy if they like Twitter, but they don't like it at the current price and they think it's at very good value at $34. And they want to get paid to wait for the stock to fall. If the stock never falls to that price, they can continue to sell cash accrued puts and continue to make $60 every couple weeks or every single month. They continue to pile in money until eventually it gets to that price, and then they buy 100 shares. Because they were making money while they were waiting, their actual break even when they get into the stock is going to be less. But that's about all I'm going to say for cash accrued puts right now. If you want to learn more, there's videos. Check out the playlist for Webull, Robinhood, or options trading for beginners on this channel. You can also join the Patreon, which gives you access to the private Discord server, and you can ask me questions there. It's $5 a month. It's super cheap. You get access to live trade alerts, to stock market news and updates, to a watch list, and it's a community of other investors and traders where we share our ideas. So let's go back to the other screen to see what other options strategies we have. We have covered calls and buy right. Now, a covered call, you need to have 100 shares to do that. A buy right is buying 100 shares and then selling a call option against it, which is basically a covered call anyway. If you don't have 100 shares and you hit covered call, this is the error you're going to get. As you can see, selling a covered call needs 100 shares per contract as collateral, while you only have 0 shares on this position. It's my recommendation that you accumulate 100 shares and then just sell a covered call and not do this buy right strategy. But what the hell? We're gonna dive into it anyway. So let's click buy right. To keep it simple, we're going to pick the same expiration date, which is the 16th of September. Now, when you're selling covered calls, you want to pick a strike price that is above the current share price because you want to try to sell as many covered calls as you want, and you don't want your covered call to expire in the money. So the same situation, we're going to sell an out of the money call with a probability of it being out of the money at 80% or higher. So what we're going to do is we're going to sell the $45 call for the expiration of the 16th of September, and we're going to buy 100 shares. So that's the one we're going to select. Now this is going to be a little bit more confusing. You're going to have to do some calculation to identify the price or the right price to buy this contract, because we're dealing with two things here. We're buying 100 shares and then we're immediately selling a cover call against it at the $45 strike. So the current share price of Twitter is $41.05. To make it easy, let's just say it's $41, and that's where we're going to buy 100 shares at. The next thing is we need to figure out how much we're going to sell this contract for. The spread between these contracts, not that much. It's between $73 and $79. So to make this easy, let's just say $75. So our limit price in this case is going to be the share price, $41, minus what we're willing to get for this contract at $75. I'm sorry, 75 cents. So our limit price is going to be $40.25. Now, if we scroll down and we go to our limit price, you can see that the bid is $40.39. The ask is $40.67. We're looking to do this at $40.25. You can adjust this to be whatever you want depending on how much you're willing to pay for this position. Now, if we go to the P&L graph, let's explain this a little bit more. So our max profit is going to be $475 and our max loss is going to be negative $4,025. How is max profit determined? Well, to be very simple with this, you're selling a $45 call option against it and you're buying it at $41 about. So that's a $4 difference. That's the spread between the price that you bought the stock and the covered call. That's the max amount of profit. So in our case, it's 4 times 100, that's 400. But we also were given $75 to sell that contract. So that's how you get your max profit of $475. Now, if the stock is below $45 at expiration, you can do this again and continue to collect premium, and you can move the strike price higher. You can continue to sell covered calls, continue to bring in premium, but you have to be willing to sell the stock at that strike price or buy back that contract. It's up to you what you want to do. You can also roll the contract. There's a lot of things you can do. There's a lot of things, and I'm not going to explain them all on this video. I'll save that for a different video. I've already gone over it in other videos as well. I recommend you check the playlist out. But that's essentially the buy right strategy. So if you click on done, you can proceed with the order. I'm not going to do that. Heading back to the options discovery tab, let's do a quick recap. You have leverage options, which are buying calls or buying puts. And then you have income driven strategies, which in this case are covered calls and cash secured puts. If you want to do verticals, if you want to do spreads, condors, straddles, strangles, that's going to be all done in the options chain, and you can see all the stuff you can do here as well. This new feature is tailored towards beginners. I highly recommend that you learn how to use the options chain eventually, but to get started, this is going to help lower the learning curve and get you introduced to options quicker and faster. So that wraps it up for this video. If you end up signing up for Webull, consider using the link down below. And if you deposit $100, we are going to be rewarded, and I highly appreciate it. Outside of that, join the Patreon if you want. It's $5 a month. And I'll catch you on the next video. It's been real. It's been fun. It's been real fun. And this is We Are Investing. And together we are invincible. See ya.